Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tuesday Tech Talk for Tuesday, December 28th, 2021. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks. Happy holidays.
Happy holidays. Let's start off with a look at what the market's been doing this past week with a look at the market letter.
Okay, well, last week it looked like the Santa rally was going to be derailed as we got underway. We had a lot of the spike in the Omicron cases. And we also had the failure the week before of the Senate not passing President Biden's Build Back Better bill. And we had the stocks went south. The Dow was down 699 points early in the day, but people came down and bought the dip. It kind of went down, tested some support levels, and we finished about 433 points, or about 1.25% off down for the day. We did see some buyers come in on Tuesday after the S&P 500 went down. I think it bounced off the 50-day, and the Dow bounced off its 100-day. Also, we had reports that the FDA was going to approve Pfizer and Merck's antiviral COVID treatments, and that kind of is people are kind of leaning towards the fact that this isn't going to be it's not going to disrupt the economy as much as we thought. The severity of the symptoms aren't near what they were with the COVID-19, and so once that kind of made its way through market participants, we had a nice rally at that point. The gains were pretty much broad-based after that. I think every sector last week was up, led by consumer discretionary and technology, communication services, and energy, which keeps on plowing ahead here on demand issues. And then we ended the short week on a high note with the S&P 500, gift wrapped at a new record high, which was nice. And the other indexes were also floating with new highs. We had a nice little bump again yesterday. The Dow Jones finished less than 1% off of its old high. The S&P 500 set another record high, and even the NASDAQ now is at about 1.5%. It was up almost 1.4% yesterday. So things are looking good here for the Santa Claus rally. Today we have a little bit of a stutter step, but I think we'll get into that here in just a minute. Now, as far as the technical condition of the market, it did improve last week, especially after 5 or 6 weeks being down. We were able to test support levels before bouncing off that and making the run to the new highs. The technical indicators that had been negative to neutral returned to positive ground. We had the MACD for the different indexes cross over into bullish ground. Momentum crossed up above 50, actually about 55, 56, and was on the rise again as we headed into the weekend and through yesterday. We also had most of the indexes, major averages, were back above their 50-day moving average. But as we closed Friday, the Russell 2000 and Dow Jones Transportation were still below some resistance. Dow Jones was below, the transports were below their 50, and the Russell 2000 was stalled below the 200. That got rectified yesterday. I think yesterday we saw the Russell 2000, which is the small cap index. It jumped over its 200 to 100-day moving average. That bodes well for the market going forward this week. And also we had the transports finally clear resistance at its 50-day moving average. So that should be a good thing as the market goes on. We are seeing some weakness in the markets today. Nothing real concerning. I think most of what we're seeing today is a little bit of end of the year tax. I noticed that a lot of the stocks that that are down 20%, 15-20% here over the last couple of months are seeing more weakness, and that's basically probably people just taking the losses to cancel off some of their gains for the year. And I would imagine we'll probably start seeing some buying coming back in here, if not probably Thursday at the latest, maybe even tomorrow afternoon. People want to jump ahead of the guys, figuring that they're going to buy into the stocks that were sold off earlier. So anyway, we kicked off the Santa rally a little bit early. Like I said, the investors are a little bit more optimistic now that the Omicron spread is going to be contained. The FDA approving the oral treatments to treat the symptoms. That's always a good plus for the start for the market to keep on going. This should historically, the Santa rally goes into about the second day of first 2 trading days of January, and normally sometimes it even goes further than that. Historically, one of the things that I talked about earlier is the small caps that lead the Santa rally, but this year I'm not quite sure it is. They did get a nice bounce here the last couple of days. We'll have to see if that carries off over into January. But the momentum index, as far as the MarketEdge momentum index, is a neutral. We did see some of the the underlying breadth indicators improve. We did the NASDAQ and NYSE advanced decline lines, which kind of are leading indicators of market direction. They both gained units last week. We also saw new 52-week highs and lows. The lows contract a little bit. However, negative divergence is still seen in the fact that we're still seeing more new lows than new highs. That's been a problem. That's been going on for 5 weeks. So we want to watch that. And in fact, I think yesterday, even as the S&P 500 was making a new high, the NASDAQ still had more new lows than new highs. It has 130 new highs to 198 new lows. Sentiment sentiment's pretty neutral right now. We saw the pros and the retail investors kind of rein their enthusiasm a little bit. That's actually good for the market going forward. It allows them that they start to think that they're missing something. They're going to want to jump in. Actually had a big inflow of into funds last week. We had $12.5 billion come in. That's one of the reasons why you see get the Santa rally, is because a lot of the 401k retirement plans and stuff pay out. You see that money work its way into the market. We'll probably see a big influx of funds this week also. So that looks good. As far as what's leading the market, we're still seeing building materials, semiconductors, auto manufacturing. Of course, a lot of that is due to Tesla. And on the weak side, although we did see a big jump after we got the oral pills approved last week, casinos and airlines and other recreation were some of the weaker groups on 50-day relative strength. But again, we saw those jump probably 10%, 7 or 8% last week, and some of this week as if we're not going to be shutting down due to the new pills and stuff with the Omicron, that will help the some of the transportation and reopening stocks a little bit with that. So again, it looks like we should I would think we'll probably see the Dow Jones. We actually did see a new high earlier today. I think the old high was 36,432, and we got up above that by about 50, 60 points earlier today. We're right there. We're about 30 or 40 points away from a new high in the Dow right now. But I think we'll probably see that take out its old high here probably before the end of the week. And again, I think if you're long here, or I think you maybe look at some stocks you want to buy the buy the dips again. Yesterday, we got a nice kick from MasterCard. Reported that retail sales had jumped 8.5% year over year. That was the biggest jump in 17 years. So if people have money and they're spending, they're looking at demand for energy. Crude oil was up again. I think it's going to be up for a fifth day today. And crude oil prices have jumped 15% in December, and that's basically because investors are looking for demand to pick up here in the start of the year as we move into January. So right now, I think this end of the year melt up should continue into January, and we'll see whether or not the January effect kicks in, which is however the first week of January goes. That's generally how the month of January goes, and usually how the year goes. So we'll look at that maybe in the next week or two.
All right, and so we started the Santa rally with the S&P 500 at a new record high, and today looks like we'll give some of the gains back. But what does the new year look like?
All right, there's a lot of this time of year you get a lot of analysts out there. Everybody wants to make a name for themselves, and they're gonna, oh, it's gonna go up 20%, it's gonna go down 20%, and you see a lot of that, and they don't really know. So what we have to look at basically is what happens historically. One of the things we do here at MarketEdge, we have the CTI, which is the Cyclical Trend Index. It looks at different cycles in the market. It's been very accurate. It's outperformed the Dow over the last 30, 35 years. As far as the CTI goes, it looks like we're going to stay positive here into February, and then we're probably due for some selling. Probably towards in the March and April. We'll see how that goes. And once we make a bottom at that point, we'll see how the market reacts from there. But I think we're okay here for a couple more weeks as we get the new year rolling. And there's also another theory that I just wanted to touch base on. That a lot of people look at, and one of them, Judd Hirsch does this with the Stock Traders Almanac, and that is the presidential cycle, which is has an awful good track record along with the cycles and everything else. And one of the things that has is that is the second year of the president's term is usually the weakest year of his 4 years. And there's several reasons for that. One of them is that after the president usually gets elected, they owe a lot of favors to people, and they want to they push agendas that are maybe from special interest groups, that type of thing. The people that help them get elected, they kind of work a little bit overtime to try to appease that group, and then that kind of has the market pull back. And then once they get into year three, basically what they're trying to do there, they want to make sure the economy is strong, because they want to get it reelected. So they start pushing the agenda that's better for everybody. But the second year, they're still kind of weaving in and out of what they should do. So now about Trump, that was a little bit of a difference, because he was cutting taxes at the time. Because of that, we actually saw a good bump on his second year that he was in office. But Schwab has done a study of this going all the way back to 1950, and they found that in general the second year was probably the weakest. The third year, the presidential cycle, is good. And I think going back to 1950, the second year had an average return of about I think just right around 5 or 6%, whereas in the third year, the returns will jump up as high as 15, 16%. So between the CTI, not having showing some weakness, it'll be as the 4-year business cycle will be from 2020 when we bottomed. Here's we get in, we'll be starting to kind of wind down the business cycle towards the second half of 2022, which will probably that's when a lot of these cycles will start to roll over. We also have the headwinds from possible rate hikes, which will right now they're calling for 3. That's going to be a headwind. Of course, we still always have this COVID thing going on. That if we see another variant pop up that is resistance, that would throw everybody's projections into the out the window. But the way it looks right now between the CTI and the presidential cycle, I think right in here, January should be a decent month, maybe going into February, and then we'll probably have some churning, maybe a little bit of a pullback. I don't see any real extended long periods until maybe around June. We'll start to see more weakness in the market. Probably not a great summer next year, but in general, I think we'll probably be positive. And at this stage, I think you buy the dips for a little bit longer, and then maybe we start to spin out. I think the key in here right now, though, is to keep an eye on the small caps. We were hoping they were going to break out, which they did, I think, at the end of October or into November. But then that was aborted very quickly, and about a week or so later, after that breakout in the Russell 2000, it came all the way back down. It went to the bottom end of its trading range, which we're back into now. And on the top end of that, we want to see that. Keep your eye on the Russell 2000 to see if it can, break out again. I would say if we see that break out at around, I would say you see the Russell get up about 23.20 again, 23.25, 23, that area. If we see it go above that, then I would say that that's probably a good bet that we can see the market, the broader market, gain some more strength. And that would, again, right now we see the Russell, it's back in its trading range, and we need to see that thing breaking out.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.